We saw the local market here in South Africa didn't manage to escape the sell-off that we saw on European markets today. Of course, we weren't hurt as badly as we're seeing European markets trading in some of the Asian markets. But what were your views on the data that came through from China and how the market reacted to that import side of the equation?
Hi, good. So the Chinese data showed that there was a surprise surplus, additional surplus on the Chinese trade data. The take on that was that they actually had a slowdown in imports, which actually took a negative perception that perhaps there was a slowdown in their production outlook. So the market took that negatively, coupled with the nerves coming out of Spain as those yields continued to push higher, budget deficit constraints coming into play there. And our market, in fact, held very well in light of the sort of global pressures that are going around at the moment.
Why do you think that's so, Grant? Do you think that people just had a good Easter weekend and they just weren't prepared to buy into all the doom and gloom today?
It could be. I think we've got a very order-driven market at the moment. There was clearly a good bit of buying around in the domestic industrials, and banks particularly held up very well today and actually really saved the market. They saved the day. The banks index ending up over 1%, and a number of the industrials up as well, the defensive stuff. However, resources did come under a bit more pressure, and they were saved by the rand. So the rand had a massive move out, over 15 cents, which is really big in by normal standards, and that definitely had an impact in saving our market from some of the global fallout we're seeing at the moment.
Do you think that the strength that we've seen in the banking sector is justified because the market perhaps been reactive to some of the news flow from the likes of Standard Bank reducing its exposure to a Turkish venture, FNB saying that it's planning to spend 2 billion rand in the next year in order to fund its expansion in Africa. But overall, though, do you think that this rally that we've seen in the banking sector is justified by their plans?
It's difficult to know whether it's justified, but I think what appeals to people is the fact that there's a certainty, or there's an element of certainty in the earnings and the outlook. It doesn't have the same uncertainty and the same risk profile as the resources currently do with the kind of global instability at the moment. So I think on a relative basis, the banks are still offering value. They are becoming fairly full and fairly stretched at these levels, but it once again falls into a relative category. And it's not looking too bad on that basis.
So safer bets, basically, than the resources sector.
Yes.
Looking at one of the stocks that really was hard hit today, Anglo Gold Ashanti, sitting at the bottom of the top 40, down by 3%, closing the day at just over 260 rand. Looking at that quarter one update, it really seems that the market reacting badly to the news flow around the impact that safety stoppages has had on production so far.
Yes, I think that did come in as a disappointment. They came in below their own guidance. And production sort of letdowns at this stage of the game are really not what the market's looking for. The market is looking for safety in these gold counters, and having operational and other issues, production shortfalls, just really doesn't bode well for the outlook. And I think some investors just getting tired of holding on to these sort of underperforming stocks and just dumping, just getting out.
Your views, though, on the gold sector in terms of the fact that they are increasing exposure outside of South Africa, increasing exposure to markets where there's more stability, perhaps in the labor markets. Do you have, or will you get any further exposure to the gold sector right now in light of the fact that they're increasing exposure to other parts of the world?
I think the increased exposure to other parts of the world is a very positive thing. I think the more they can diversify their risk base, so to speak, the better, and investors are looking for that. So I think that's a positive trend until such time as they deliver sort of consistent production and operational sort of performances. The sort of skepticism may well remain for a little while. And so I think many people find more appeal in the physical commodity than the shares at the moment.
Let's focus in on some of the other resource stocks that have been particularly hard hit recently. Sasol's share price down by 1 2/3% today. Just talking to a technical analyst, they see that share price possibly bottoming out at 330 rand. When you see that share price falling to these levels, surely a buying opportunity, given the fact that most say the oil price is fundamentally not going to fall quite dramatically from these levels.
I think I would agree with you on the basis that the actual rand oil price is very high at the moment. The stock has had a significant retracement from its recent sort of highs, and we do believe it presents fairly good value at these levels, and we'd certainly be looking to start accumulating around current levels.
So Grant, what stocks are you accumulating at these levels aggressively? Where are you quite active in the market? Where are you seeing the best opportunities to get into the market right now?
It's a tricky one in that there's a lot of overvalued, or not overvalued, fully valued areas. Some of the areas where we see some sort of value is, we like the industrial sector, we like the imperials of the world, we like, as I said, we like the Sasols. On a relative basis, we do see value in resources. Yes, there's a higher risk profile, but the earnings yields, the forward PEs and the like are very low, very undemanding, and we see a decent amount of upside from there if you have the risk appetite to sort of sit through the short-term volatility.
In terms of volumes right now, 11.7 billion rand going through the markets, an average day for the markets. Are you expecting that to take place for the rest of the week? Of course, being a holiday shortened week with the Easter holidays still here?
Yes, I think with everyone on holiday and a lot of people coming back only this week or next week, we would expect volume to be a bit lower. Having said that, with all the goings on in the world, some guys are forced into action even if they'd rather be sitting on the beach.
So really, if you've got positions, perhaps having to rethink some of those positions, of course, as we see markets re-rating down generally across the board.
Yes, absolutely. I think this is a tricky time to. I think some people would like to sit on their hands, but there's certain instances where something needs to be done. There is a lot of noise in the system at the moment, a lot of nerves, a lot of risk. You can see that in the currency move. You can see that in some of the European economies. Italy, for example, down nearly 5% today. So a difficult time to stay out of the market.